Welcome to today's webcast where we will talk about secured lending and crypto assets. My name is Demet Tunç. I lead the Customer Experience Council at the Conference Board. Today my speaker Orkun Akseli, who is an associate professor at Durham University of Law School, is going to be with us, and he's going to update us on very important topics such as secured lending, crypto assets, cryptocurrencies, blockchains, and so on. Welcome, Orkun.
Thank you very much, Demet. Thank you for having me here.
Thank you for coming all the way from UK. Before we go into the topic of the session, let me give you a couple of tips about watching this webcast. You can ask questions throughout the program by typing in the boxes that is provided at the bottom left of your screen. If you wish, you can also view the full screen of the presentation that Orkun is going to share with you. The presentation is made available for you. If you would like to download it, you can easily do so. We would encourage you to share this program within your network, with your colleagues, and with people who are interested, as it's quite a hot topic, especially for the people in finance, law, and commercial. By joining this webcast, you can earn CP credits. To be able to do so, you need to type in your name 3 times. During the webcast, which will appear, and provide your details so that you are eligible for the CP credits. One last thing, at the end of the webcast, we will ask you to complete a very brief evaluation form so that we improve ourselves for the future webcasts. Okay, that was all about the practical tips for joining this webcast. Again, Orkun, it's a pleasure to have you here. Orkun is an expert in secured transaction law, and he has several publications. He's also written several books on commercial law. And as I am responsible for customer experience, I thought of having him as a speaker because law, transactions, and financial topics are always part of the commercial business world. And Orkun has collaborated with several institutions, organizations, international organizations, including the World Bank, United Nations are, I think, amongst the several of them, right? And as I said at the start of the webcast, he's also teaching. He's a professor at Durham Law School of Durham University Law School. Yeah. And so again, Orkun, while we were discussing about having a webcast, you told me that this is such a hot topic today. And let me start with the first question. Why is it a hot topic? Why are we talking about secured lending and crypto assets today?
Thank you, Demet, for having me here. It's a great pleasure. Secured lending and crypto assets, these are 2 important topics at the moment because secured lending has been done in commercial life between merchants, between banks and merchants for thousands of years. But crypto assets has come into the equation just recently in the last couple of years. So there's a sort of interesting synergy between these 2. And it's like shooting a moving target because every day, every week, something is happening in terms of cryptocurrencies, crypto assets, digital assets. And the question is whether crypto assets can be used as collateral in financial world. So 80% of trade in the world is financed by some form of financing. And secured finance sometimes can be complex, costly, and time-consuming because banks
and
have to do...
And also risky.
Absolutely, because banks and financiers have to know their customers and the debtors, whether they are creditworthy, and it's the know your customer, know your client notion as well. In most cases, small businesses are having difficulty in accessing to finance because of their assets and collateral, and sometimes they are not regarded as creditworthy by banks. So banks have to choose, or financiers have to choose, whether to lend on a secured or an unsecured basis. And of course, there is the problem of intermediation. In most cases, intermediation increases the cost of agency, and blockchain, in a sense, reduces that agency cost by creating a decentralized, disintermediated system. With the advent of blockchain, there is an opportunity to tackle with some of those problems, financial inclusion or financial exclusion, as well as reduction of the low cost of credit.
And is it also a cheaper way of transaction, blockchain?
It should be, once all the regulations are in place, and that people are doing what they should be doing, and when there are clear rules and regulations in place, I think it could be.
But today it isn't.
But today it isn't, because most financial regulation authorities are still trying to find a way how to regulate cryptocurrencies, how to regulate the blockchain and distributed ledger technology systems. So it is important that once these are in place, once regulations are in place, parties should be able to transact according to these rules.
And I believe every country, every region has its own regulations. So it must be a very complex environment of transactions, because every country has its own way of working. Or is there like laws that are common, at least per Europe region or per Asia region, for example?
Absolutely. Obviously, every country has its own financial regulation system, although some of them are similar to each other. There are multinational, supranational organizations, Basel III rules, which simply require countries to adhere to those high-level principles. So these are important things, and it is important that there should be cooperation among financial regulation authorities in terms of achieving a well-working, regulated environment for blockchain and crypto asset transactions. So I thought this could be something up and coming, and I have started doing research a couple of years ago on this.
And you recently published a paper, right, on this topic?
Yes, a paper is forthcoming soon on this digital assets and secured lending, which looks at the compatibility of the United Nations model law on secured transactions and crypto assets, while looking at the comparative perspectives, looking at some important laws that influenced secured transactions around the world. So looking at the problem from that perspective, I think secured lending is important in crypto assets. It raises a number of questions, whether crypto assets, bitcoins, negotiable instruments, shares and bonds, which are denominated or based on blockchain, can be used as collateral. Whether Bitcoin, Ethereum, or cryptocurrencies, other cryptocurrencies, are property. So these are important things when thinking about using them as collateral in secured lending and secured transactions. Businesses,
because such an interesting topic. I'm really looking forward to listening to your insights and your experience on this topic.
Thank you.
It's very interesting.
So what I would like to do today is to first of all look at what blockchain is and how it can be used, whether it should be regulated, and the limitations about using blockchain and blockchain-based currencies and so on. And then I'd like to look at a number of issues related to secure transactions law, whether it's property, whether cryptocurrencies are money, and and their treatment under different jurisdictions, and the compatibility issue of ancestral model law and secure transactions law, because it's an important model which is currently used as a model in those countries that are planning to reform their secured lending and secured financing laws. So without further ado, I'd like to look at what blockchain is. It's a method of data storage on the ledger. Ledgers have been used for centuries by merchants on a paper-based, but this is something that can be used among a number of people, a number of merchants, and it's a single master central registry of cryptographically secured Bitcoin transactions.
At the start of your conversation, you said that secured lending is a terminology that's been used over years. But blockchain, crypto assets, cryptocurrencies, since when have they been used in the marketplace?
This blockchain has come into our life probably less than a decade ago with an article by a Japanese author, and there are disputes about whether that person really exists. So cryptocurrencies obviously came within the last couple of years. Blockchain, very recent. So obviously when we have the digital assets that we don't touch, we don't feel, then the question is whether we can be able to use them as collateral. Say a business buys a certain amount of bitcoins, or a business uses shares and bonds based on blockchain, whether they can be able to use them as collateral in return for funding from a financier, whether a bank will accept those sort of things, those sort of assets as collateral in return for providing financing to that business. So these are important things. So many developments are happening at the moment as we speak. So there are certain things that I would like to cover in today's webcast.
I believe that the companies, the businesses would use these kind of products. Can I call them products?
Absolutely,
these kind of products only if they see the value in it.
Yes.
So what's the commercial value? Does it decrease the cost? Does it improve the efficiency? If they see the value for their business, I think these products would become more tangible products,
yes,
tangible assets than it is today. There's so many questions and uncertainties about it because probably people don't really understand the value of these products.
Yes, I think it is about understanding whether crypto assets, whether bitcoins or digital assets, digital shares and bonds, whether they are important for a business, whether they would like to continue with it. I mean, when we look at insurance business or supply chain business, bill of lading and letter of credit transactions, they will be going into that blockchain-based systems.
Sooner or later.
At some point, yes, within the next probably 5 to 10 years. There are a number of reports, and I think the recent one is produced by the WTO and the ICC about a reality check, and they were talking about what are the constraints of this type of system and how this can be regulated, what should be done. There are projects going on in many businesses. So it will be interesting to see what will happen in the future.
Yeah, it is like the digitization of everything. 10 years ago, we were talking about it, and today everything is digitized.
Yes.
And probably this is also something similar to it. Maybe in the future, this will become a regular vocabulary of our lives.
Probably, yes.
We will be talking about cryptocurrencies instead of euro currency, for example, because it will be part of our lives.
Yeah, exactly. I mean, It's an interesting thing because we can't call a cryptocurrency or a Bitcoin a traditional fiat currency or a money like euro, dollar, or British pounds, because they don't, as I will mention in a couple of slides later, they do not fulfill the conditions of a traditional money
Currency.
or traditional currency. But because only people who accept to trade on these on this basis, on the Bitcoin basis, will be using it, whereas US dollars or British pounds or euro can be used and accepted and has the currency all around the world, just like other currencies. So it could be something that we can use, as you mentioned, in a couple of years' time. It will all depend whether certain concerns are answered by the regulators, as well as by the people who are using it or who are willing to use it, or who are issuing those currencies. So it's as I said, an important field that is still moving fastly, and we'll see what will happen in terms of cryptocurrencies and their acceptability.
And what's the role of the academic world here? Do they drive the decisions? Do they drive the regulations? Are they an important influencer, opinion leader, or are they just watching and letting go and see what will happen?
I think it's a great question. Academics are part of the process. We're not driving it further, but we are helping the process as to what should be, what...
You're shaping it up.
We're shaping it up, yes. We're part of the process, working together with the policymakers, practitioners, and the private sector. We can't think of a life without the academics, obviously.
Okay. So you're still a big part of the equation.
Exactly, we
Okay.
are. And from a different perspective, I'm pro-regulation because regulation makes things much easier. As we have seen, deregulation makes things quite difficult, as we have experienced in 1929 and 2008 financial and global crisis. So going back to blockchain, it's a growing list of records, blocks, which are linked and secured through cryptography. So the sender must digitally sign the proposed transaction to the public address of the recipient with her private key. And the address to the set of keys is called the wallet. And it underpins cryptocurrencies like Bitcoin and Ethereum and so on. It's managed autonomously using a peer-to-peer network. And each time a new block is included, it's done according to a collectively adhered protocol, because a consensus is necessary in using blockchain. So there's a decentralized consensus among the people who are using this blockchain system. It's disintermediated, and that helps parties to reduce the agency costs. So when there's no one in between, it eliminates the agency costs, which is supposed to reduce the
total cost.
The total cost of the credit. Exactly. It's also resistant to modification of data. Once the data is registered, it cannot be amended retrospectively. There are pros and cons about this, because once data is registered, it's assumed to be correct. But in terms of shares and negotiable instruments and so on, we have to be careful about this, which I will discuss shortly. So the idea is to decentralize and streamline the financial transactions on a global scale. But we will see whether it's going to happen. And I believe if there's a clear regulatory response to these issues, I think it may or it might decentralize and streamline financial transactions. Blockchain can be used as a means of storing data as well. It's an attempt to build a payment system that didn't rely on a trusted authority such as a commercial or central bank. Because we know that payment systems are run by central banks and commercial banks. And the blockchain system maintains a record of payments and balances that we call the ledger. And anyone can participate in the validation of the Bitcoin system as long as they are happy to use that system. The interesting thing here is this, because cryptocurrencies work on a peer-to-peer networking system, and they are independent of any central authority, they are not regarded at the moment as any traditional currency. They will not be able to probably replace.
So crypto asset and cryptocurrency are two different things.
Well, crypto assets is an umbrella term. It includes both the currency, receivables, the money that you expect from a third party or from your debtors, as well as shares and bonds and negotiable instruments like check. So these are all umbrella terms that we use to cover crypto assets.
I see.
So physical cash, for instance, can be spent once, but Bitcoin and digital assets or digital files can be duplicated. So that's something also different than the traditional currencies. So where are they used? What do we do with this? We can use this in trade finance, supply chain digitization, supply chain finance, in insurance business, know your customer, bill of lading, shipping, and letter of credit. These are all important areas that we can use a blockchain system because it stores data. Provided there are regulations in place, they can be used as a medium of exchange. Currently, it's a medium of exchange between people who accept Bitcoin system. It can be used in financial services, in smart contracts, and distributed cloud storage, loyalty programs, supply chain communication. So what are the advantages and disadvantages of using this system? So the advantage is that we manage data. It validates, stores, and synchronizes information. It accelerates the decision making in a sense. There are cost and time reductions arising from the removal of intermediaries because there's a peer-to-peer lending system. It stores data in a blockchain form, so there's this sort of immutability. It cannot be changed once it's entered into the system, except by consensus among the users.
It's all registered, it's trackable.
Exactly. Well, trackable in a sense, as long as we know the public address of the other person. And that's generally the private key of that other party. So that is both an advantage and a disadvantage, in my opinion. Mm-hmm. There is an advantage for lenders, I think, because there is the creation of instant, permanent, and immutable records of transactions, which enhances the auditability and the transparency of transactions. There is another question which I was thinking about in the last couple of months, whether blockchain and crypto assets is a remedy or are remedies for financial exclusion or financial inclusion. And I came to the conclusion that it's financial inclusion is a socioeconomic problem rather than anything else. So in addition to blockchain and crypto assets and their regulation, there should be other points by organizations and governments to be thought about.
And are the governments in a way promoting the usage of these, or not at all?
I should be neutral on this because there's no support or no.
They are neutral.
Neutral, exactly. Governments are neutral because without knowing fully what exactly will happen in terms of regulating and how they should be regulated, particularly initial coin offerings or crypto assets and cryptocurrencies and so on. Governments, I don't think, should be able to immediately bring any laws and rules. There are consultancy papers, for instance, both in the US and in the UK, as well as in Europe. Some of them are still ongoing. Some of them have just finalized their reports. For instance, Fed in the US reported a warning that global stablecoins could wreak havoc in the global community or global economy, because there are certain problems about their operation, liquidity, and credit. There was a new phenomenon by Facebook, Libra, stablecoin. I think the danger is that if something goes wrong, there could be run on the issuers of those coins, bitcoins, and the people who bought these or who buy these coins may demand the return of their fiat currency, because you buy something with a traditional currency. And I have seen in a number of countries there are ATM machines which sell both Bitcoin and Ethereum. So you put your credit card or your debit card, and then you purchase these. And in the report, Fed said issuers must disclose how their staking mechanism works. Issuers must protect customers and their data privacy, but maintaining know your customer to prevent any illicit use, that is money laundering, obviously. And also the third one is issuers must disclose their terms of service. And finally, issuers must inform their customers if they have any rights to the underlying asset. So these are important things that investors should look at when they are purchasing cryptocurrencies and crypto assets in the first place.
Yeah, but as you rightly said, there is a big socioeconomic benefit, actually, or benefit to be proved.
Yes.
And I understand the fact that the governments are not promoting it, and it again comes back to my value creation question, because probably the governments also do not see or do not have a proof of the value that will be produced for the benefit of the customers, of the end users, of the consumers. Then they're also preventing themselves to promote it. But if they see the socioeconomic value and the benefit, then I think the regulations could also move much faster. And it may take some time, but I believe that it might go quite fast once it's there.
I entirely agree with you, because it is probably a political issue as well as a commercial matter. I think governments are generally in a wait and see situation. Once they are certain about the regulatory perspectives, once the regulations are in place, they will probably go into enacting new laws that will cover the lending of these types of assets. Obviously, there are concerning issues. There are issues that we should be concerned as lawyers. There are issues that businesses should be concerned. There is the interoperability, whether the project needed to be used in blockchain reaches a critical mass. So it's okay to use blockchain system between 2-3 people, but if it's not, if it doesn't have any further demands, then it's expensive, because the
cost per head is going to be very expensive.
Exactly. So the interoperability is an important issue. The other one is the legal concern. Recognition and the reliability of electronic signatures and electronic documents. So not every country has the same type of system in place for the recognition and reliability of e-documents and e-signatures. There is the standardization where businesses come to a certain level in creating standard transactions, and of course the privacy issue. But there is an important point which I found in a report. Cryptocurrencies and blockchain has capacity constraints. For instance, they cannot handle payment volumes required currently. 30 million electronic transactions per day are conducted in the United Kingdom, as opposed to 600,000 globally per day in terms of Bitcoin.
So what's the reason that they can't handle the capacity today?
Well, I mean, it's people don't know how to use the blockchain system. It's new. It could be in the future reach to that capacity, but currently there are constraints. So we cannot be able to immediately convert everything into blockchain system, and let's use blockchain system and leave everything else. I think we will need time to reach to that capacity. But the capacity constraints also means high transaction costs, and that brings us to the question of lowering the cost of credit. If we want to lower the cost of credit, we need to get rid of all those additional reasons that increase the transaction costs. Verification requirement by participants means limited speed as well. So there are a number of issues, a number of limitations, in my opinion. And also, as I mentioned earlier, crypto assets and the cryptocurrencies are not being used as a medium of exchange because they are currently failing to perform the three key functions of money: as a store value, as a means of payment, and as a unit of account. So these are the three important points that that money has, fiat currency has, but the cryptocurrencies or Bitcoin doesn't have any of these at the moment. So the question is, should we regulate this area? I think regulation is an important field. I think they should be regulated because deregulation causes problems. Deregulation means that we leave everything to markets. While it's good to leave things to market or market players, there are certain risks.
Regulations that need to be in place.
Exactly.
Otherwise, if it's not regulated, everybody will do their own thing.
Absolutely. We have seen the deregulation which created the housing bubble between 1998, 1997 and 2007. And I think that was the warning that Fed provided in its report that there could be a risk to global economy, and it could lead to economic threats to economic stability. The other thing is Bitcoins have volatile prices. Volatile prices means you buy something for $5 today, and then tomorrow or in the afternoon the price may change to $10. So volatile prices makes things difficult when you enter into transactions on the basis of trusting a currency. We know when we enter into a transaction on a fiat currency that the currency's value won't change dramatically. So that's an important issue. So it has to be regulated by some means. There is also the minimal consumer protection. I think this is an important point for client experience and consumer experience, because consumer protection, all businesses are consumers, one way or the other. So they have to be protected. Even though they have sophisticated legal protection, they have to be protected. And there should be some protection in place by virtue of a sort of regulation. There is also the anonymity of aiding money laundering. So therefore, regulatory perspectives are important. It provides sustainable growth and reduces risk. So I'd like to ask to our viewers, what do they think about regulation? Should there be regulation or should there be deregulation in terms of cryptocurrencies and blockchain phenomenon?
Okay. Well, there's a question from Orkun to the audience, and you can type in your question by typing in the answer to the space provided. So the question is, do you think this should be regulated or not, and why? Okay, when the answers come, I will let you know.
Absolutely,
Orkun.
that would be great.
Let's continue. I know
Sure.
you have many slides, but the way you talk, you're already covering the topics, the content of the coming slides.
Perfect. And that brings us to the issue of secured lending and crypto assets as collateral. So what are security interests? What are secured transactions? What is secured lending? Secured transactions are those transactions that secure the payment or performance of an obligation. Property rights arising out of secured transactions which secure the payment or performance of an obligation is an important part of our life. Merchants and banks enter on a daily basis those sort of transactions. Banks require collateral. Businesses provide that collateral in order to obtain some funding from the bank or financiers. Security interests provide the secured creditor with the right to seize and sell and realize the value of the encumbered asset, the right to apply the proceeds realized from the asset, and the right to enforce the security interest against third parties. It's a sort of property right against third parties. So most financiers feel protected when they have a security over the assets of the debtor. And it's also a sort of bargain. If you get a security, if you get a collateral, you provide, or you're supposed to provide, credit at a low cost because you are protected by the collateral. You can seize, sell, and realize the value. So that brings us to the question of whether crypto assets are property.
Or can they be used as collateral?
Yes, if they are property. And whether they can be used as collateral. Yeah. Exactly.
Once something has a value, you say that that is a collateral, right?
Yes, I mean, because we purchase it with, we purchased the Bitcoin with traditional fiat currency. So that means that it should be an asset, it should be used as a collateral, and it really should be, in a sense, property. But I thought about looking at very briefly the characteristics of property, and then we can be able to ascertain whether they are. So a property has to be identifiable as someone else's property or someone else's asset by a third party. So if that laptop is yours or iPad is yours, then it should be identifiable as your iPad. It must be definable. What is it? It's an iPad. It's XYZ brand name iPad. It must be capable in its nature by assumption by third parties. So you should be able to sell and obtain some money out of it, and you should be able to purchase with money, etc. It must have a permanence and stability. It must have scarcity and exclusivity. So looking at this, number of Bitcoins mined are kept to the exclusive use of users who control the keys. So that means
it's a property.
It's a sort of property among the people who are accepting the use of Bitcoins. And it has to be specific. It must be linked to an identifiable source. It must be identifiable as somebody else's, Mr. or Mrs. Brown's property. So from that perspective, it is important. And blockchain is append only. That means transactions can be added to the blockchain record. A record added can't be altered. All records are understood to be correct. Nobody is checking it. And to guarantee this blockchain record, they have to be determinable. And this is important in terms of negotiability in financial instruments. Because the legal title passes with the delivery of that negotiable instrument or that document. And the negotiability remains subject to the requirement that a transferee takes the instrument in good faith if there is a problem, which we have seen in a number of cases around the world. And the legal title to stolen securities remains with the victim. But this can't be applied to blockchain because information or information can't be determined because we don't know the proper identities of the people. We only know a private key, and it's sometimes so difficult to follow that key. Who owns that key? Who doesn't own that key? So the asset that represents a Bitcoin is the knowledge of that private key, of that Bitcoin, and the person with control of that private key allows access to cryptocurrency, and that is the owner.
And by the way, I am receiving some answers to the question you have raised.
Fantastic.
Somebody says that perhaps a balanced approach to regulation would avoid freezing innovation and putting cryptocurrencies out of reach of retail buyers and startups. So there needs to be a balanced approach to regulations.
Absolutely, a fantastic answer. I entirely agree with that. I like balancing approach. The reason why balancing approach is an important approach, we shouldn't be stifling entrepreneurship. Startups are important and they have to be supported. In most cases, they cannot be able to access to finance. So what are they going to do? Either peer-to-peer lending or some sort of usage of Bitcoin. So it is important, and I totally agree with our viewer who presented that response and perspective. And I thank you for the comments. So I have discussed that it is not a money, cryptocurrencies or digital currencies, virtual currencies. They are not money because they do not rely on fiat currency issued by a central bank. But there are central bank-backed cryptocurrencies, or there will be. There are studies on that. When that happens, I think it would be much more trusted by businesses who would like to use Bitcoins. And it will also provide a sort of stability to the value of cryptocurrencies. In fiat currency, we know that the extrinsic value is imposed by the state, but in cryptocurrencies, extrinsic value is not imposed by the state. It's imposed by the users. So
by the market.
By the market, exactly. And it changes on a day-to-day basis. Someday you buy it for 600 euros, the other day it goes to 1,400 euros. So you don't know where you stand. It doesn't happen in euro, dollar, or yen or yuan. There is much more stability in those currencies. Therefore,
but at the same time, there is dynamic pricing in the e-commerce business. So the prices are very variable. So I somehow link it to what's happening in the e-commerce world. So this is somehow similar to the dynamic pricing model the companies are using when the end users purchase their products, because here this is also very variable and it depends on the time of the day you want to buy and purchase your product.
Absolutely.
Which in this case is a cryptocurrency, Bitcoin or whatever. Yeah.
Perhaps, yes. Yeah. I agree. Probably in transactions there could be a sort of anchoring the value of the Bitcoin on a particular day. The value represented on that day could be used. From the regulator's perspective, probably this is not sufficient. The reason is, as a unit of account and store value, Bitcoins or cryptocurrencies do not fulfill the criteria. They are too volatile, and of course, not many people are using Bitcoins as a medium of exchange. So that creates a problem in terms of their money. But in my opinion, asset with any market value, as long as you purchase it with a fiat currency, can be used as a collateral, and that's why it increased my interest in this field, whether they can be able to used as collateral. So looking at a number of different laws, I found that under English law, cryptocurrencies are not regarded as money. They are not cash because it must be held in an account, in a bank account. Obviously, in terms of property rights, we have to have the separability, exclusivity, transferability, and it must have a value. Some of those are present. Um, so the issue is private key is the confidential information. So
Data privacy.
exactly, and I don't need to know your private key to your Bitcoin account. And the law doesn't attribute property rights in confidential information currently. So that brings us to a point. What are they? Are they really property? And if they are really property, can they be used in different jurisdictions? Because some laws look at from a different perspective than the others. For instance, when we look at the Uniform Commercial Code Article 9 of the United States and Personal Property Security Acts, the UCC Article 9 says it's not simply it's silent. It's not money. It has to be hand-to-hand money, not virtual, and it must be a medium of exchange currently authorized by a domestic or a foreign government in order to be regarded as money. It's not in a deposit account. We all have deposit accounts, or most people in the world, which can be demand time saving, passbook maintained accounts. And Bitcoin doesn't fulfill any of those conditions. There is one interesting case from a Texas court which says in the investment context, Bitcoin is a currency, form of money limited to those places that accept it as currency. Therefore, the argument is it could fall under the general intangible concept of UCC system. Personal Property Security Acts talk in a similar manner. It's not intangible because all personal property, not goods, chattel paper, documents of title, these are intangibles, but Bitcoin or cryptocurrencies are not regarded at the moment. It's not an investment property. So laws need to go through some sort of reform in order to cover this area at some point.
So there are some practical and legal challenges then in using secured lending with crypto assets.
Absolutely, absolutely. And that brings us to the question of their enforceability, volatility, non-negotiability, because these are the problems and risks in practice. We have to be able to enforce our secured rights in the event that the debtor defaults or goes bankrupt, because Bitcoins and cryptocurrencies are volatile in their practice, in their prices, in their values. That brings us to the enforceability problem. Again, general intangibles are non-negotiable, and it causes a sort of problem in blanket lien. So just to give an example, a merchant may accept Bitcoins as payments, but over its business, a bank has a security right. So in that case, the bank should also be able to accept Bitcoin in order to allow the merchant to accept Bitcoin. So there are a lot of issues to be sorted out, to be regulated in the next couple of years. So where does the new international or transnational texts or text stand in terms of blockchain technology and the ancestral model law on secure transactions? One of the key objectives of the ancestral legislative guide and the model law is to allow debtors to use their full value inherent in their assets to support credit. So any asset with market value may be used as a collateral. That's the origin of modern capitalism, because it enables borrowers to borrow on a low rate of interest. And there are four issues, I think. We have receivables denominated in a cryptocurrency. Receivables are intangible book entry commercial bank monies owed to a business. So you expect a certain amount of money, that's called right to payment or book debts, from your debtors. And These are generally traditional currencies in the ledgers of banks. They are virtual, they do not exist tangibly. And cryptocurrencies are virtual chain of codes, and they are in distributed ledgers. So as long as the institution holding the bank account, where a right to payment of funds credited to a bank account is an authorized deposit-taking institution, they can receive cryptocurrencies, and this may include an online wallet provider as well. And in most countries, by virtue of their banking laws, most businesses, most banks, financiers are authorized deposit-taking institutions. So they can accept receivables denominated in the cryptocurrency. So ancestral model law, in that sense, is compatible with this phenomenon. And the other issue is units of cryptocurrencies. Cryptocurrency units are movable assets, money is tangible, and currency authorized by a state as a legal tender. So we have to have the reasonable description in the security agreement, and they must be identifiable. So we have the problem of generic and specific description, which is also related to the enforceability. And we have the third-party effectiveness. That is, once you create a security interest, it has to be effective against third parties by registering it in a general registry that is generally kept by Companies House, for instance, in England, or in other countries. There is a similar issue. So the argument is we can equate possession of private key to possession of the tangible asset. I think the better solution could be control, where the secured creditor controls the private key, that is not by possession. The other issue is blockchain-based tokens representing negotiable documents. There can be three types of tokens: utility tokens, security tokens, and payment tokens. Utility tokens are used for a particular purpose, for purchasing something. Tokenized security and represents ownership are the security tokens, and we have the payment tokens. Negotiable instruments are generally tangibles. These are checks and so on. They can be represented by tokens, which become intangible, electronic negotiable instruments. And in that sense, we can be able to say that any country that is planning to adopt the model law should also adopt the ancestral electronic transferable mobile records law, which grants control, exclusive control, which is the same as possession, in order to complement the model law on secure transactions. But the problem here is, where is the electronic negotiable document located? That's still unclear.
Where is it kept?
Exactly. The final point in that sense is blockchain-based tokens representing securities. Every company has securities. They have shares and bonds. So these are non-intermediated securities, and they have a securities account. And blockchain-based tokens representing securities are peer-to-peer basis. Therefore, they are non-intermediated securities.
So blockchains or cryptocurrencies can be used as shares and stock options?
We can create electronic shares and bonds on the basis of blockchain, on blockchain-based systems. So when that happens, they will be uncertificated, non-intermediated securities, because there's no intermediation, so they are non-intermediated, and there's no security, there's no certification, so they are uncertificated. And these are all covered by the ancestral model law on secure transactions. So there is the compatibility as well. Finally, we can use blockchain and distributed ledger technology as security rights registry. The important issue here is this. For a registry, we have to have the existence of a registrar, just in case something happens when parties register their secure transactions. So public blockchains are not administered, and private blockchains may be suitable, and the registry must preserve all information contained in the registry record and reconstruct the registry record in the event of loss or damage. Blockchain is difficult to hack because data is replicated to every node of the work, but we have seen that there are possibilities, such as in the MT-GOX and Bitstamp cases, that hacking and certain other issues are in the possibility. So in my opinion, distributed ledgers on a private blockchain might serve as registry. And where do we keep that registry system? And that brings us to the question of conflict of laws. This is important in terms of perfection of a security interest, and we still don't know where the blockchain-based registry system may be located. So this has to be resolved in the reform as well. Finally,
before the final, we also have some attendance again from the audience. Bahar Gökçe, she says that regulation need is inevitable, I think, but it should be kept at a level not to get in the way of the practical nature of the system. Regulation will be necessary for international taxation, customs procedures, invoicing for international trade, I believe.
Absolutely. I agree with our viewer that as the other viewer clearly said, there must be a balanced regulation. And I think that's what all the governments and financial regulation authorities are thinking. There are problems with the enforcement of bitcoins, and to wrap up this issue, there is a lack of central authority, irreversibility and traceability, and the description of the bitcoins. And finally, in conclusion, I would say that bitcoins or the private key that represents them are property. They are assets. They can be used as collateral. Cryptocurrencies are not money. Cryptocurrencies can be used as collateral. UNCITRAL model law is compatible, but it needs to be adopted together with the UNCITRAL model law on electronic transfer of documents. Blockchain-based registry is appropriate as a private registry. However, there are still problems with conflict of laws and perfection, and there are problems with enforceability. And that concludes my remarks on this interesting topic. And thank you very much for your kind invitation.
Well, Orkun, this is very enlightening. It's a topic that I'm not very hands-on, and as a viewer myself, it really brought lots of knowledge, and I believe that in 2-3 years' time, all these things will be part of our lives, and we will go back and watch our webcast, and we will think how we have designed the future of transactions, maybe. So thanks a lot for your insights.
You're welcome.
Thank you for joining us. There is a small evaluation form. We would be very happy if you could complete that. As I've said, if you're interested in these kind of topics, there are several councils that cover law, tax, finance, customer experience, innovation, digitization. So please get in touch with my colleagues, and it would be very good to see the senior executives amongst these councils. Thanks again and have a good day. Thank you again, Orkun.
Thank you.